Hey everybody, welcome back to Investing with Wesley. In today's episode, I'm going to help you piece together everything you've learned so far when it comes to business entities and tax benefits of them, and help you really understand how you could strategically structure placing these entities in your life and in your finances to save the most money possible on taxes. Let's get into it. So one thing I'm not sure if I mentioned in one of my previous videos is that companies can actually own other companies. And in a sense, business entities can own other business entities. It's a bit more than just buying out the competition. Like, a business can buy another business, but they can also create another business just like the owner of that business created it. And a lot of people actually don't know that, and that is one of the big downsides of the lack of education people have on setting up these business entities for tax-efficient purposes. So let me give you a quick example on how one business can own another business, and how if it's structured properly and set up properly, they could pay almost $0 in taxes. So in this example of the business we're going to set up, our main focus is going to be to pay as little as tax as possible, and if we can, to pay as zero tax completely. So the first business we're going to create is pretty much any business entity. For the sake of argument, we're going to go with the OG business model, the C Corp. Now this C Corp is going to be called Company X. Now Company X, like I mentioned, does not want to pay any taxes on all of its profits. So its goal would be to hire the best tax attorneys out there as well as best financial analysts out there so that they could set up a foolproof plan to pay zero taxes. So that's exactly what they do. So Company X is being told to set up another company, and this company, Company Y, is going to be set up and based out of the Camen Islands. Now, one important thing you should know about the Camen Islands is that they have zero taxes on everything. There's no corporate tax, there's no income tax, there's no dividend tax, there's no capital gains tax. When I mean it, there is literally no taxes on anything. They are considered a tax-neutral territory. So Company X sets up Company Y in the Camen Islands. Now, Company Y strategically owns the intellectual property rights to a particular platform that Company X has to use to do its business. Let's just say Company X was in the business of selling shoes, and the particular design that they wanted to put on these shoes was the intellectual property that Company Y owned. So what happens at this point? Well, Company Y licenses out the right to use that intellectual property to Company X. So after making and selling these shoes, Company X profits $1 billion. But they don't want to pay taxes on any of that. What do? Well, because Company Y has the intellectual property rights to the design that Company X was using, Company X has to pay Company Y a royalty or a licensing fee to use that intellectual property. So what happens at this point? Well, conveniently, Company Y will charge Company X a fee in order to use that intellectual property. And this particular fee is going to cost Company X $1 billion. So even though Company X profited $1 billion from selling these shoes, they have to pay $1 billion to Company Y in order to satisfy the licensing fees that Company Y is charging them to use their intellectual property. So the profits that Company X had are now at zero, so they can't be charged taxes on the profits that they no longer have because of this massive $1 billion expense that they had to write off for this licensing fee. As well as Company Y now profits $1 billion, but because they're based out of the Camen Islands where there is no tax, they don't owe any taxes on the $1 billion in profit. Now remember, Company X owns Company Y, and they both work together for the same goal. The goal was Company X pays $0 in taxes on its profits. And by setting up another business to act as a holding entity for the intellectual property rights of the design that they were using for these shoes, they managed to completely skate by paying the federal government $0 in taxes just because they understand how licensing law and the expenses that come with business deductions work. So although they sold $1 billion worth of shoes, because businesses are taxed only on their profits and their expenses are deducted from their gross profits, their net profits ended up being $0, and they had to pay the federal government $0 in taxes. Meanwhile, their subsidiary, Company Y, was holding $1 billion worth of untaxable profit in their accounts. But let's be honest, most of us don't have billion-dollar companies, and most of us can't afford to pay these giant teams of attorneys and financial analysts the amount of money it takes to really come up with a bullseye strategy like this example entailed. So what options do the smaller business owners have, or what options do the real estate investors have, or just what options are there for average people trying to lower their taxable burden? Well, here's another example that's a little easier to follow and understand. Let's say you have a piece of real estate, and it doesn't really matter if it's your primary residence, second home, or an investment property. And I know if it's your primary residence, sometimes they can qualify for a primary residence exclusion in the event that you sell. But for the sake of argument, none of that matters. You just have a piece of real estate and you're trying really hard not to pay any taxes because you know you're about to sell it for an extreme profit. What can you do? So let's say many years ago, you got lucky and bought a house in San Francisco, California for $200,000. In today's market, that would be well over $1 million. And you want to sell that property and take all of your profits and move somewhere that's a little slower pace and a lot quieter. What can you do? Well, like we already established, your main goal is to keep as much money as you possibly can and not lose it to the government taking it in taxes. Because whether it's a primary residence, second home, or an investment property, when you sell a piece of real estate for a capital gain, you're going to have to pay capital gains taxes, whether it's long-term or short-term. Well, the best thing you could do is to get in touch with a property appraiser and get it documented exactly how much that piece of property is worth in the event that you sold it or refinanced it. And then once you have that piece of paper from the appraisal giving you the exact dollar amount that your property is worth, you go to a bank or a credit union. And basically you ask for a home equity line of credit or a home equity loan, and you pull out as much equity as humanly possible. And this would work whether you still have a mortgage on it or not. But because you bought this property so many years ago for so cheap, let's just say you've already paid it off and it's free and clear. You do a cash out refinance or you take a home equity loan and you strip as much equity as they'll allow, and that's usually up to 90% of whatever the property is worth. So if the property is worth $1 million, typically they'll let you take either 80% or 90% of that, which would equate to about $800,000 or $900,000 in this cash out refinance. So you're lucky enough to get 90% loan to value, meaning they cut you a check for $900,000. You put that $900,000 in your savings account, your investments, whatever you want to do with it, that $900,000 is yours. Now you list your home on the MLS and you list it for the exact price that the appraiser appraised that property for. So a couple weeks go down the road and you've officially sold your home for $1 million because, like I said, that's how much it was actually worth. Well, how does this work come taxes? Because you just sold your home for $1 million, you're under the impression that you're going to owe taxes on this $1 million. And like I said, you don't want to pay any capital gains tax. Well, what a lot of people don't know is that loan proceeds aren't taxed as income. So the $900,000 you got from stripping your equity from this home and taken as a loan, none of that money is taxable. Instead, only the profits you received from selling your home are taxable. And when you sold your home, you had a $900,000 mortgage on this property. So $900,000 of the $1 million you sold it for goes to pay back that home equity loan or line of credit that you took your equity out of. The remaining $100,000 does go to you as profit, but after you factor in all the expenses in closing costs as well as realtor fees, you're only sitting at about $80,000 worth of profit, and long-term capital gains on $80,000 is way better than long-term capital gains on $1 million. So just because you were wise enough to strip all the equity you could from your home via a home equity loan or line of credit before you sold it means that all the profits you would have made and had to pay taxes on go to paying off those giant mortgages that you had on that property. And the proceeds you got from the loan prior to you selling it are all tax-free because the government does not recognize loan proceeds as income. Structuring your real estate deals in this way or structuring and building your businesses in the previous examples way are two great examples of tax strategy being used at its absolute best. And everything that we just talked about is completely 110% legal and is allowed in the United States tax code. The truth is, before you got this knowledge, you would have sold that home for $1 million, or you would have just paid the taxes in that property that you had selling shoes. You wouldn't have set up that other business in the Camen Islands, and you wouldn't have taken a home equity line of credit, so you would have been stuck paying an extremely high tax bill. But instead, all you had to do was change a couple things around, and now you're paying little to no taxes at all. And like I said, this real estate example was just one home, but for professional real estate investors out there that own multiple properties, let's just say it comes time for you to retire and you no longer want to be a landlord, you can liquidate all your properties and get away paying as little taxes as possible doing it this way, as opposed to paying all the taxes on all the proceeds that you collect from selling your investment properties. Understanding the tax code and the benefits that business entities have on taxes really can help you lower your tax burden in incredible ways. And after all, whether you're an employee, an entrepreneur, or are lucky enough to own a large business, taxes are still your largest expense. So it makes sense that we would do everything in our power to lower our taxable burden and lower our largest expense. If you did get value from this video, or if you did learn something today, please remember to share it with your friends so that we can help them understand and save everyone a lot of money. Until our next episode, have a good one.